Look, I need you to pay very close attention to what I'm about to tell you, because what's happening in the silver market right now is something most investors won't see coming until it's too late, and by then, the opportunity will be gone. Just yesterday, silver breached $32 per ounce in a matter of hours. 10 hours. That's all it took for spot silver to gain 4.6% and hit levels we haven't seen since the post-election sell-off. But here's what nobody's talking about. This isn't just another price spike. This is the beginning of something much bigger, and the next 72 hours could determine whether you're positioned to profit or left watching from the sidelines. Let me paint you a picture of what's really happening behind the scenes. While everyone's been focused on gold hitting new records, silver has been quietly setting up for what could be the most explosive move we've seen in decades. And I'm not exaggerating. The fundamentals, the technicals, the institutional positioning, everything is aligning in a way that happens maybe once or twice in a generation. You see, silver just did something remarkable. It surged past $60 an ounce recently, with some analysts now calling for $75 as the next target. Think about that for a second. We're not talking about a 10% or 20% move here. We're talking about silver potentially doubling from where it was at the start of this year, when it was trading around $30. That's the kind of move that creates generational wealth for those who see it coming. But here's where it gets really interesting. The London market just experienced what traders are calling a short squeeze. Now, if you're not familiar with what that means, let me explain it in simple terms. A short squeeze happens when traders who bet against silver, who borrowed silver to sell it, hoping to buy it back cheaper, suddenly realize the price is going up instead of down, and they panic. They have to buy silver to cover their positions, which pushes the price even higher, which forces more short sellers to cover, which pushes the price higher still. It's a feedback loop that can send prices absolutely vertical. And that's exactly what we're seeing right now in London. Spot silver climbed as much as 3.9% above $52 an ounce, exceeding last week's peak. But then something fascinating happened. Silver fell from its record peak as investors booked profits. It dropped about 3% to $61.70 per ounce after hitting a record high of $64.64 earlier in the session. And now, most people look at that pullback and think the move is over. They see profit-taking and assume the party's done. But that's exactly the wrong way to think about this. That pullback? That's not weakness. That's consolidation. That's the market catching its breath before the next leg higher. And here's how I know that. Retail investors are taking delivery of physical silver at record rates. Let me say that again because it's crucial. Record rates. They're not just buying paper silver on exchanges. They're demanding the actual metal. They're pulling supply out of the market and creating additional upward pressure on prices. When you see that kind of physical demand combined with a short squeeze in the paper market, you're looking at a powder keg. But let's dig deeper into why this is happening now. Because timing is everything in markets, and understanding the why behind the move is what separates the investors who make life-changing returns from those who miss the boat entirely. First, let's talk about the supply situation. Silver production has been relatively flat for years. We're not discovering massive new silver deposits. The easy silver has already been mined. And here's the kicker. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal mines slow down or shut down, silver supply gets squeezed, even if silver prices are rising. It's not like gold where you can just open more gold mines when prices go up. Silver supply is much more inelastic. On the demand side, you've got multiple powerful forces converging all at once. Industrial demand for silver is absolutely exploding. Solar panels use silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure requires silver. The green energy transition that governments around the world are pushing, that's massively silver intensive. We're talking about structural demand that's going to persist for decades, not just a cyclical uptick. But here's where it gets even more compelling. Investment demand is surging at the same time, and not just from retail investors like you and me. Central banks, which have been accumulating gold at record pace, are starting to look at silver too. Why? Because they understand what's coming. They see the same thing we're seeing, a monetary system under stress, currencies being debased, and hard assets becoming increasingly valuable. Let me tell you a story that illustrates this perfectly. Back in 1980, silver hit $50 an ounce during the Hunt brothers' attempt to corner the market. That was a speculative bubble that popped spectacularly. But here's what's different now. We're not seeing speculative excess. We're seeing fundamental demand. In 1980, there was no solar industry. There were no electric vehicles. There was no massive industrial demand for silver. It was purely a monetary play. Today, even if investment demand disappeared entirely, industrial demand alone would support much higher prices. And speaking of monetary plays, let's talk about what's happening in the currency markets, because this is where things get really interesting. The dollar has been under pressure. Not catastrophic pressure, but steady, persistent pressure. And every time the dollar weakens, precious metals strengthen. It's an inverse relationship that's been true for decades. But what's happening now goes beyond normal dollar weakness. We're seeing the early stages of what some analysts are calling de-dollarization. Countries around the world, particularly the BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to reduce their dependence on the US dollar for international trade. They're setting up alternative payment systems. They're trading in their own currencies. And they're accumulating gold and silver as reserve assets. Now, I know what you might be thinking. I've heard about de-dollarization before. It's been talked about for years. Why should I believe it's different this time? Fair question. Here's why. The pace is accelerating. China and Saudi Arabia just completed their first oil transaction in yuan instead of dollars. That's massive. The petrodollar system, which has been the foundation of dollar dominance since the 1970s, is starting to crack. And when that system breaks down, the implications for precious metals are enormous. Think about it this way. If you're a central bank and you're watching the dollar's role in the global financial system diminish, what do? You can't just hold yuan or rubles or rupees as your primary reserve asset. Those currencies have their own problems. So you buy gold, and increasingly, you buy silver, because precious metals are the only truly neutral reserve assets. They're nobody's liability. They can't be printed or debased, and they've held value for thousands of years. Quick aside here, and this is important if you're thinking about your own financial future. If you're sitting on $100,000 or more in retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical gold into your retirement account without tax penalties. It's in the description below. Worth checking out if that's relevant to your situation, especially given what we're seeing in these markets. Anyway, back to what's happening with silver right now, because the next piece of this puzzle is absolutely critical to understanding where prices are headed. The COMEX, which is the major exchange where silver futures are traded in the United States, is showing some very interesting positioning data. Commercial traders, these are the big banks and institutions that typically hedge physical silver production and consumption, have been reducing their short positions. Now, why does that matter? Because commercial traders are usually on the right side of major moves. When they're heavily short, it often means prices are near a top. When they reduce their shorts, it often means they see higher prices ahead. At the same time, large speculators and hedge funds have been building long positions. But here's the key. They're not over-leveraged yet. We're not seeing the kind of extreme speculative positioning that typically marks a top. There's still room for more buying. A lot more buying. And then you've got the technical picture, which is absolutely screaming bullish. Silver just broke through major resistance levels that had held for months. When you see a breakout like that on heavy volume with strong fundamentals behind it, the odds of a sustained move higher are extremely high. Technical analysts are pointing to $75 as the next major target, but some are even talking about $100 silver within the next 12 to 18 months. Now, I want to take you back in history for a moment, because understanding past silver bull markets can give us a roadmap for what might happen next. In 2011, silver hit nearly $50 an ounce during the aftermath of the financial crisis. That move was driven by fear of currency debasement, quantitative easing by central banks, and a flight to hard assets. Sound familiar? We're seeing all of those same factors today, but amplified. Here's what happened in 2011. Silver went from about $18 in mid-2010 to nearly $50 by April 2011. That's a 178% gain in less than a year. And it wasn't a straight lineup. There were pullbacks, consolidations, moments where it looked like the move was over. But each pullback was followed by an even stronger rally. The investors who stayed the course and didn't get shaken out by the volatility made extraordinary returns. But then the move ended. Silver crashed back down, eventually bottoming around $14 in 2015. Why? Because the fundamental drivers changed. The Fed started talking about tapering QE. The dollar strengthened. Fear subsided. The trade got crowded with weak hands who panicked at the first sign of trouble. So the question is, are we in a 2011-style bubble that's going to pop? Or is this something more sustainable? And this is where you have to look at the differences, not just the similarities. In 2011, industrial demand for silver was strong but not growing rapidly. Today, industrial demand is not just strong, it's accelerating. The solar industry alone is projected to consume massive amounts of silver over the next decade. Electric vehicle production is ramping up globally. These are structural trends that aren't going away. In 2011, central banks were buying gold but largely ignoring silver. Today, we're seeing increased institutional interest in silver as both an industrial metal and a monetary asset. The narrative around silver is changing from poor man's gold to the metal of the future. In 2011, the financial system was in crisis mode, but the underlying structure was still intact. Today, we're seeing fundamental questions about the future of the monetary system itself. The debt levels are higher. The currency debasement is more extreme. The geopolitical tensions are more severe. The case for hard assets is stronger than it's ever been. Let me give you another historical parallel that's even more relevant. In the 1970s, silver went from $1.50 an ounce to $50 an ounce. That's a 3,233% gain. Now, I'm not saying we're going to see that kind of percentage move from current levels, but I am saying that the 1970s provide a better template for what we might be experiencing now than 2011 does. Why? Because the 1970s were characterized by persistent inflation, currency instability, and a loss of confidence in the monetary system. The Bretton Woods system collapsed in 1971 when Nixon closed the gold window. Suddenly, the dollar wasn't backed by gold anymore. It was just paper, and people rushed into precious metals as a store of value. We're seeing echoes of that today. The dollar isn't backed by anything except faith in the U.S. government's ability to manage its finances, and that faith is being tested. The national debt is over $30 trillion and growing. The Fed has printed trillions of dollars in recent years. Inflation, while it's cooled from its peak, is still running well above the Fed's 2% target. And there's no clear path back to the kind of monetary stability we had in previous decades. In that environment, silver isn't just a speculation. It's insurance. It's a hedge against monetary chaos. And increasingly, it's being recognized as an essential industrial metal for the technologies of the future. Now, let's talk about what's happening in the physical market, because this is where things get really fascinating. There's a growing disconnect between the paper silver market, the futures and derivatives traded on exchanges, and the physical silver market where actual metal changes hands. Premiums on physical silver coins and bars have been elevated for months. What does that mean? It means people are willing to pay significantly more than the spot price to get their hands on actual metal. When you see sustained high premiums, it's a sign that physical supply is tight. And when physical supply is tight while paper prices are rising, you're looking at a market that's fundamentally mispriced. The U.S. Mint has reported strong demand for silver eagles. Dealers are struggling to keep inventory. Delivery times are stretching out. These are all signs of a market where demand is outstripping supply at current prices. And when that happens, prices have to rise to bring the market back into balance. But here's the thing that most people don't understand about the silver market. It's tiny compared to other asset markets. The entire above-ground supply of silver that's available for investment is worth maybe $50 billion. That's less than the market cap of many individual tech stocks. It's a rounding error in the bond market. It's nothing in the context of global wealth. What that means is that if even a small percentage of global investment capital decides to flow into silver, the price impact could be enormous. We're not talking about needing trillions of dollars to move the silver market. We're talking about billions. And in a world where central banks are printing trillions, where sovereign wealth funds manage trillions, where pension funds and endowments control trillions, it doesn't take much to move a $50 billion market. Let me give you a concrete example. If just 1% of the money currently sitting in money market funds, which is over $6 trillion, decided to move into silver, that would be $60 billion, more than the entire investable silver market. The price would have to go significantly higher to accommodate that kind of demand. Now, I'm not saying that's going to happen tomorrow, but I am saying that the potential for a massive move in silver is there. The market is small. The fundamentals are strong. The technical setup is bullish, and the macro environment is increasingly favorable for hard assets. So what does all this mean for you as an investor? What should you be doing in the next 72 hours? First, understand that we're at a critical juncture. Silver has broken out to new highs. It's pulled back slightly as profit takers exit. But the underlying trend is still up. The fundamentals are still supportive. And the next move could be explosive. Second, recognize that timing matters. If you wait until silver is at $75 or $100, you'll have missed a significant portion of the move. The time to position yourself is when the setup is clear but before the crowd arrives, and that's where we are right now. Third, think about your risk tolerance and position sizing. Silver is volatile. It can move 5% or 10% in a single day. If you're going to invest in silver, make sure it's money you can afford to have fluctuate. Don't put your rent money or your emergency fund into silver. But if you have investment capital that you're willing to commit to a high-conviction trade with significant upside potential, this could be one of the best opportunities we've seen in years. Fourth, consider the different ways to gain exposure to silver. You can buy physical coins and bars. You can buy silver ETFs. You can buy silver mining stocks, which offer leveraged exposure to silver prices. Each approach has its pros and cons. Physical silver gives you direct ownership but comes with storage and liquidity considerations. ETFs are convenient, but you don't own the actual metal. Mining stocks can multiply your returns, but they come with company-specific risks. My personal preference, and this is just my opinion, is to have a core position in physical silver, and then potentially add exposure through ETFs or mining stocks, depending on your risk appetite. The physical silver is your insurance policy. It's the asset that will be there no matter what happens in the financial system. The ETFs and mining stocks are your speculation on higher prices. Fifth, and this is crucial, don't try to time the exact bottom or top. You're not going to buy at the absolute low and sell at the absolute high. Nobody does. The goal is to capture the majority of the move. If silver goes from $32 to $75 and you buy at $35 and sell at $70, you've still made a 100% return. Don't let perfectionism keep you from taking action. Now let me address the elephant in the room. What if I'm wrong? What if silver doesn't go to $75 or $100? What if it pulls back from here and trades sideways for months? It's a fair question, and it's one you should always ask when someone is making a bullish case for any investment. Here's my answer. The risk-reward is still favorable. If silver pulls back to $28 or $30, you're looking at maybe a 10% or 15% downside from current levels. But if the bull case plays out and silver goes to $75, you're looking at a 130% upside. That's an asymmetric bet. The potential gain is much larger than the potential loss. And here's the other thing. Even if silver doesn't make a massive move in the next few months, the long-term case for silver remains intact. The industrial demand trends aren't going away. The monetary instability isn't going away. The supply constraints aren't going away. So even if you have to wait longer than expected for the payoff, the fundamentals support significantly higher prices over time. But I don't think you're going to have to wait that long. The setup right now is too compelling. The breakout is too clean. The fundamental drivers are too strong. And the market structure is too bullish. Let me tell you one more story that I think encapsulates what we're seeing. A few months ago, I was talking to a friend who runs a precious metals dealership. He told me something that stuck with me. He said, "I've been in this business for 30 years. I've seen bull markets and bear markets. I've seen bubbles and crashes. And what I'm seeing right now in the physical silver market is unlike anything I've experienced before. The demand is relentless. The premiums are persistent. And the buyers aren't speculators. They're people who are genuinely worried about the future of the monetary system and want to own real assets. That conversation crystallized something for me. This isn't just a trade. This is a fundamental shift in how people think about money and value. And silver, because it's both a monetary metal and an industrial metal, is uniquely positioned to benefit from that shift. The next 72 hours are critical because we're at a decision point. Either silver consolidates here and then breaks higher, or it pulls back and gives us another entry point. Either way, the trend is your friend. And right now, the trend is unmistakably up. So here's what I want you to do. Take some time today to really think about your exposure to precious metals. Look at your portfolio. Ask yourself if you're positioned for what could be one of the biggest moves in the silver market in decades. And if you're not, ask yourself why not. Because here's the reality. Opportunities like this don't come around often. When all the stars align, fundamentals, technicals, sentiment, market structure, you have to pay attention. You have to act. Because by the time everyone else sees what you're seeing, the easy money has already been made. Silver is telling us something right now. It's telling us that big money is positioning for higher prices. It's telling us that physical demand is overwhelming supply. It's telling us that the monetary system is under more stress than most people realize. And it's telling us that the next major move could happen very quickly. The question is, are you listening? Are you positioned? Or are you going to look back 6 months from now and wish you had acted when the opportunity was staring you in the face? I can't make that decision for you. But I can tell you this. The critical hours are here. The setup is clear. And the potential rewards are enormous for those who have the courage to act on their convictions. Silver isn't just a metal. It's a message. And right now, that message is loud and clear. Something big is coming. Make sure you're ready for it.